Welcome to my channel. I'm Scott, and in this video I am going to walk you through the process of valuing BHP Group stock by analyzing their financial statements and dissecting their financial ratios so we can determine if it's a buy or a sell. BHP Group is a mining, metals, and petroleum company. The company is headquartered in Australia and was founded in 1885. It went public in 1984 and currently trades on the New York Stock Exchange. It's the world's largest mining company based on market cap. It's also Melbourne's third largest company by revenue. It has mining operations in Australia, North America, and South America. Its petroleum operations are in the US, Australia, Trinidad and Tobago, the UK, and Algeria. The company has four primary operational units: coal, copper, iron ore, and petroleum. Copper is really popular because there's a lot of copper used in EV cars, a lot more than traditional cars. So if you want exposure to copper, you can buy BHP. Let's get started with the model. This is a large cap company, 173 billion market cap. They're trading at $70 a share, and they have 2.5 billion shares outstanding. Let's look at the financials. The way you value a company is you estimate the free cash flows into the future, and then you discount those numbers back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. So you can see they have a lot of free cash flow. It peaked in 2018 at 13.5 billion. It dropped to 8.8 billion in 2020, but that's still a lot of cash flow. Net income is the profit and loss on the income statement. It's revenue minus expenses. That peaked in 2019 at 8.3 billion. Not much lower in 2020 at 8 billion. Revenue is the sales for the company, and that grew from 2017 to 2019 up to 44 billion. It dropped a little in 2020 to 43 billion. This is the company's income statement. The top line is the revenue, the sales. Below that is the cost of revenue. These are the expenses directly related to generating the revenue. An example is the cost of labor. The difference between those two numbers is the gross profit. That peaked in 2019 at 28 billion. It's down to 26 billion in 2020. Below that is operating expenses. An example is depreciation. Then below that is operating income. And that was the highest in 2019 at 16.7 billion. It's down to about 15 billion in 2020. Still a good number. Below that is their interest payments. And you could see they paid $880 million of interest on their debt, much lower than prior years. They did have a big financing cost of 1.2 billion, and they didn't do much financing in prior years. Below that is other income and expenses. This is usually impairments or write-offs. Then you have your pre-tax income, then your taxes. And the bottom line of the income statement is their net income. And they had a lot of net income in 2020 at 8 billion, a little less in 2019 of 8.3 billion. The reason their net income was so low in 2018 was they paid $7 billion of taxes on just $14.8 billion of pre-tax income. When you look at the income statement, I would focus on operating income. The stuff below operating income is not part of a company's operational business and can skew the numbers. This is the company's statement of cash flows. The top line is operating cash flow. That's how much cash the company generates from its operational business. That peaked in 2018 at 18.5 billion. It was the lowest in 2020 at almost 16 billion, but still 16 billion is a lot of operational cash flow. You could think of operating cash flow as net income converted to cash. Net income is your accounting profit and loss. It's not actual cash. That's what I was trying to mention earlier, that the income statement can be a little deceiving due to accrual accounting. Operating cash flow is a much better indicator of a company's financial health. You could also look at EBITDA, but I like to look at operating cash flow. This company has a lot of CapEx. CapEx is your investments in property, plant, and equipment. Based on the nature of their business, they spend a ton of money, nearly $7 billion in 2020. Operating cash flow minus CapEx give you your free cash flow. And free cash flow is the cash that's remaining to pay a dividend, to grow your business, buy back stock, or pay down debt. This company cut their dividend last year, so they stopped paying a dividend. And it looks like they're using their free cash flow to pay down debt. Each year they pay down a lot more debt than they issue. In 2017, they paid down over $7 billion of debt and only issued $1.6 billion. So they paid down about $5.5 billion of debt. Then they paid down $4 billion, $2.5 billion, and about $1.7 billion. Dividends aren't the only way to reward shareholders. Another way is to buy back stock. When a company buys back stock, it decreases the shares outstanding, making your shares more valuable. They bought back over $5 billion of stock in 2019. Let's look at the capital structure. $48 billion of equity, $27 billion of debt. They're 64% equity, 36% debt. Their net debt is $14 billion. And their WACC is 8.3%, and that's a discount rate we're going to apply to the future cash flows. We estimated 4 years of future free cash flows. We also estimated a terminal value, which is all cash flows past year 4, that's $239 billion. We discounted those numbers back to today using the weighted average cost of capital. We get a value of the company of $217 billion. We divide that by 2.5 billion shares. And we get a calculated stock price of $88. They're trading at $70, so they're trading at a 20% discount. It's a buy according to the model. Simply Wall Street is in the other direction. They're valuing the stock at $58. They're saying it's overvalued. They're saying it's a sell. 3 analysts priced this stock in the past 3 months, and each analyst came up with $87 a share. So they're right with me. This is the stock price the last 5 years. It looks like the stock price has doubled since 2016. It looks like it got close to $80 a share a couple weeks ago, but it's come back down a little. This article mentions their last dividend payment was in June 2020. This is to conserve cash during the COVID pandemic. I'm sure they'll bring back the dividend this year or next year. And this company's beta is 0.91, so the stock moves with the market. The stock has gone up 90% in the past 52 weeks, while the S&P 500 went up 51%. The 52-week low was 36, the high was 82. And the stock is trading above its 200-day moving average, but below its 50-day moving average. About 2 to 3 million shares are traded each day on this stock. Just about all the shares outstanding are on float. Only 4.5% of the shares are held by institutions. That's surprising. And about 0.5% of the shares are shorted. If you include dividends, this stock returned over 100% to its shareholders, while the industry 130% and the market 68%. In the past 3 years, this stock has outperformed the industry and its market. Also in the past 5 years, this stock has outperformed the industry and the market by a lot. Analysts are projecting this company's earnings to decrease 11%, while the industry increases 17% and the market increases 19%. Also, analysts are forecasting their revenue to decrease 6%, while the industry increases by the same amount and the market increases by 10%. In the past 5 years, their annual earnings grew 40%, much better than the industry of 22% and the market of 12%. But in the past year, their earnings dropped 26%, much worse than their industry, which dropped 5%, and the market grew 3%. If you invested $10,000 into this company 10 years ago, you would have been really low at one point. But if you would have held on, your $10,000 would have been about $12,000 today. That's only a 2% annual return. The biggest shareholder is BlackRock at 6.7%, then Vanguard, then Norges Bank, Elliott Management, and Capital Research. Let's look at their financial ratios. The average PE in the market is 32, the median is 22. PE is stock price over earnings per share. To calculate earnings per share, that's net income over shares outstanding. They're at 21.8, so investors are paying about $22 for $1 of earnings. That's pretty close to the median. Price to sales is stock price over sales per share. They're at 4.0, which is between the median and average. Price to book is stock price over book value per share. They're at 3.6, which is a little worse than the median. Their return on invested capital is 15.5%, and their WACC is 8.3%. That's what you want to see, a nice spread between the return on invested capital and the WACC. That means they're a profitable company, and they need more money pumped into the company so they can continue generating these profits. Interest coverage ratio is EBIT over interest expense. They can easily cover their interest payments. ROE is net income over equity. They're at 17%. They have a great ROE. Current ratio is current assets over current liabilities. They're at 1.4. They have a really good current ratio. And their current assets are $13 billion of cash, $4 billion of receivables, and $4 billion of inventory. The company is well capitalized. They had almost $9 billion of free cash flow, $6.6 billion of working capital, and no dividend payment. So they have $15.5 billion of funding. The best way to look at ratios is to compare them to companies in the same industry. I've done videos on American Battery and Tech, both in the same industry as BHP. And if BHP has a number in red, they're worse than the average. If they have a number in blue, they're better than the average. They're the only company of the three with positive earnings, so they're at the average. They're the only number. They're worse than average in price to sales and price to book. They have a good current ratio. They have a great ROE. They're doing well in debt, and they're by far the biggest company. They could eat these companies up. And they cut their dividend. Tech still pays a dividend. So to summarize, I have them trading at a 20% discount, but this is a huge company. For a long-term play, I think you should be fine, but you might have to wait out the bumps in the road. I ranked their free cash flow 6 out of 10, their revenue 7 out of 10, and their ratio 7 out of 10. So let me know what you think. Give this video a like, subscribe, or comment below. Also, if you'd like to get a custom valuation or just support the channel, you can become a member by clicking on the link in the description below. Thanks for watching.